Your neighbor's kid throws a baseball through your window. The window cost $200 3 years ago. A brand new replacement costs $300. So the question is, how much does insurance pay you? If you said 300, you're wrong. If you said 200, you're closer, but you're still probably wrong. The real answer depends on three words your exam is absolutely going to test you on: indemnity, actual cash value, and replacement cost. Let's break all three. Indemnity is the core principle of insurance. It means the insurance company will make you whole. Not better, not worse, exactly where you were before the loss happened. Think of it like a reset button. It takes you back to the moment before the baseball hit your window. Not forward to something nicer, back to where you were. So how do you put a dollar amount on where you were? That's where actual cash value comes in. ACV takes what a new replacement costs and subtracts depreciation, the wear and tear from age and use. Your window was 3 years old. A new one costs $300. Minus 3 years of aging, maybe that brings it down to $210. That's your ACV. That's what the insurance company says your window was actually worth at the moment it broke. But what if you have replacement cost coverage? Then the insurance company skips the depreciation math entirely and pays you what it costs to buy a brand new window, the full $300. No age discount, no wear and tear subtracted, new for old. Here's the catch, and this is important. Even with replacement cost coverage, most policies pay ACV first, then reimburse the rest after you actually buy the replacement. You don't just get a check for the full amount up front, you have to replace it first. We'll see exactly how this plays out with homeowners claims in video 6. Let's put the official framework on this. The principle of indemnity, according to standard ISO policy provisions, states that insurance is designed to restore the insured to approximately the same financial position they occupied before the loss, not better. The whole point is to prevent anyone from profiting off a loss. If you could make money by having things break, everyone would start breaking things on purpose. Actual cash value, ACV, is the standard method for calculating what property was worth at the time of loss. The formula most states use is simple. Replacement cost minus depreciation equals ACV. Replacement cost new is 300, depreciation over 3 years is 90, ACV equals 210. Most jurisdictions follow what's called the broad evidence rule, which means the adjuster can also consider market value, condition of the item, and comparable sales, not just the formula. But for your exam, the formula is what gets tested. Replacement cost is the amount needed to repair or replace damaged property with materials of like kind and quality, with no deduction for depreciation. This is an upgrade from the default ACV settlement. When you see replacement cost coverage on the exam, the key phrase to remember is no deduction for depreciation. That phrase shows up in answer choices constantly. Now, there are two more valuation methods your exam will test. Market value is what a willing buyer would pay a willing seller on the open market. This sounds like ACV, but it's different. Market value includes the value of the land, location, and demand. ACV does not. A house with an ACV of $200,000 could have a market value of $400,000 because it's in a hot neighborhood. Insurance uses ACV, not market value, because you can't insure dirt. The land will still be there after a fire. Agreed value is a special arrangement where you and the insurer agree on the value up front before any loss happens. It's common for hard-to-value items, fine art, antiques, rare collectibles. If you insure a painting for $50,000 under an agreed value policy and it's destroyed, you get $50,000. No depreciation debate, no adjuster arguing it was only worth $30. The deal was made in advance. This comes back in a big way when we cover inland marine and scheduled property in video 8. And then there's the valued policy. A handful of states, we call them valued policy states, have laws that say if your home is a total loss, the insurer must pay the full face amount of the policy, period, even if the actual value was less. If you insured your home for $300,000 and it burns to the ground, you get $300,000, even if the home was only worth $250,000. This only applies to total losses, and only in states that have valued policy laws. For your exam, just remember, valued policy equals total loss equals full face amount, regardless of actual value. Now let's talk about where the exam tries to trick you on these concepts, because every single one has a trap. First, indemnity versus profit. The exam will present a scenario where someone receives more than their loss. If the payout exceeds the actual loss, it violates the principle of indemnity. This is the most common way they test it. They'll describe someone getting a brand new roof when only half was damaged, or collecting from two different policies for the same loss. Anytime the insured comes out ahead, that's an indemnity violation. The only exception is life insurance. Life insurance is not a contract of indemnity because you can't put a price on a human life. Second, ACV versus replacement cost on the exam. They love giving you a scenario and asking which settlement method applies. Here's the rule. Unless the policy specifically includes replacement cost coverage, the default is ACV. If the question doesn't mention replacement cost, assume ACV. And remember, even with replacement cost, most policies pay ACV first, then the remainder after replacement. If the homeowner never replaces the item, they only get ACV. Third, market value is never the answer for property insurance claims. The exam will try to slip it in as a choice. The insurer pays the market value of the damaged property. Wrong. Market value includes land. Insurance doesn't cover land. The building could burn flat and the land is worth exactly what it was before. ACV or replacement cost. Those are the two that matter for claims. Market value is for real estate agents, not adjusters. Fourth, the depreciation trap. Depreciation isn't just age. It's also wear, tear, and obsolescence. A 10-year-old roof doesn't have the same useful life left as a new one. The exam might ask what factors go into depreciation. The answer is age, condition, and obsolescence. Not market demand, not sentimental value, not what you paid for it originally. And here's the one that trips up almost everyone. Coinsurance. When a property policy has a coinsurance clause, and most commercial policies do, the owner is required to insure the property for at least a certain percentage of its value, usually 80%. If they don't meet that requirement, the insurance company reduces the payout proportionally. We'll do the full math on this in video 9, but here's the concept. Underinsure your property, and the company treats you as a co-insurer. You become your own insurance company for the gap. Let's test this. Here's an exam-style question. A homeowner's kitchen is damaged by fire. The kitchen was remodeled 5 years ago at a cost of $40,000. Current replacement cost for an equivalent remodel is $50,000. Depreciation is estimated at $10,000. The policy includes replacement cost coverage. How much will the insurer pay? A, $40,000, the original cost. B, $50,000, the replacement cost. C, $30,000, replacement cost minus depreciation. D, the insurer first pays $40,000 ACV, then reimburses the remaining $10,000 after repairs are completed. The answer is D, and here's why. With replacement cost coverage, the insurer will ultimately pay the full $50,000, but not all at once. Standard replacement cost provisions pay ACV first. ACV is replacement cost minus depreciation. That's $50,000 minus $10,000, which equals $40,000. After the homeowner completes the repairs and submits receipts, the insurer pays the remaining $10,000. Option B is tempting because the full replacement cost is $50,000, but the question asks how the insurer pays, and the process matters. Option A uses original cost, which is irrelevant. Option C uses ACV, which would only be correct if there were no replacement cost coverage. Before this video, if someone asked you, how much does insurance pay, you probably would have said, whatever it costs to fix it. Now you know it depends. ACV pays what it was worth, replacement cost minus depreciation. Replacement cost pays for brand new, no depreciation deducted, and agreed value skips the argument entirely. But all of it comes back to one word, indemnity. Make you whole. Not better, not worse. The insurance company isn't your friend, and it isn't your enemy. It's a reset button. It takes you back to the moment before the loss, and not $1 further. That principle controls every claim calculation you'll ever see on this exam.